Palantir is already a $300 billion company. Normally, companies that size are happy with 15 to 20% revenue growth. But Palantir reported earnings after the market closed today, and revenue grew, get this, over 90%. And as you can see, the market responded in kind, sending shares up by more than 10%. So what happened during the quarter, and what does this mean looking forward? My name is Brian Stoffel. As of the time of this recording, I do own shares of Palantir. Not only that, but recommended these shares this morning because it's the top of the month to members of Stock Investing Mentor. More about that in just a minute. So this was Palantir's second quarter of 2026. It's hard to say, somewhere in the ballpark of $340 billion when the market opens tomorrow. On the top line, as I said, revenue grew 93%. That's not a typo. Well ahead of analyst estimates, well ahead of the midpoint of management's guidance. Same story in the bottom line. Earnings per share more than tripled to 41 cents, beat analyst estimates, and adjusted operating income, not my favorite metric, but came in well ahead of estimates as well. Now, let's look at margins, and all of these margins include stock-based compensation. Gross margin was already at 80.8%, and it expanded about 400 basis points. Operating margin expanded to almost 50%. The net margin is over 50%. Free cash flow more than doubled. Net income more than tripled. And look at that balance sheet. Almost $10 billion in cash and zero debt. Let's go down the income statement to see how this happened. So revenue up 93%. The cost of that revenue only up 54%. Coded green because it grew slower than revenue. When that happens, you get gross profit growing even faster, more than doubling. Operating expenses, so sales and marketing, R&D, G&A, all up just 34%. That means that revenue grew almost 3 times faster than operating expenses. That's great, and that's what causes operating income to more than triple and net income to more than triple. Shares outstanding were up, but honestly, not by that much. But this only tells part of the story. Now, a lot of people have heard about Palantir, don't really realize what it does. The simplest way of putting it is, and this is oversimplified, it creates a digital twin of an operations at a business. And by doing this, which is much harder than you might think, the company is able to help create a dashboard where management teams can make decisions that are truly informed. And importantly, and the company spent nearly the entire conference call talking about this, it allows companies to have sovereign AI. Now, what does that mean? It means that instead of turning over all their data to Anthropic's Claude or OpenAI's ChatGPT, they can use those tools, but Palantir becomes the wrapper around whatever AI tool you have and keeps all of your data safe, private, and only open to you, no one else. And that is a key differentiator. To look at some of the other stats from the quarter, we're going to head on over to fiscal.ai now. All right, so what I've done here is there's actually U.S. government revenue, U.S. commercial revenue, and then non-U.S. revenue, but that non-U.S. revenue has become, it's still important, but it's not as important. And these were the two numbers that were broken out right here. So on the top, you see this is revenue from the U.S. government. That's how the company got its start. This is U.S. commercial revenue. When Palantir went public, this was the type of revenue that a lot of investors weren't sure if they were going to get able to get. And as you can see, they've done that. If you just rewind to 3 years ago, 2/3 of the revenue was coming from the government. Today, it's almost at a 50-50 split. Now, if we look at U.S. government revenue, it's growing at a very nice clip. It was growing at just 5% 3 years ago. Now it's growing at 90%, and that growth rate continues to accelerate. That's very important, but if you think that was impressive, look at U.S. commercial revenue, which at its low point was 32%, which isn't bad, but it is up to 150% growth. And on the conference call, co-founder and CEO Alex Karp talked about how the companies that aren't signing on with Palantir are the ones paying the price today, especially because they are using their tokens wildly and efficiently. And Palantir is the only one who can help them change that situation. So let's look at a couple other things of note. One is that the total customer count continues to climb. It is sitting right now at over 1,000 customers. Obviously, they go after large customers. That growth rate is coming down, but what's important, there's two pieces to this. One is you can't grow at 40 or 45% forever if you're tailoring your product to big, huge enterprises, and there's only so many of those. but it's growing 93% its revenue off of just a 24% growth in the number of customers. That means that those existing customers are using it a lot more. In fact, the company closed 220 deals of at least $1 million just during the quarter. 98 of those were at least $5 million, and 73 of them were at least $10 million. So even though that customer count might be coming down, the deals that are being signed are not. Now, if we look at the pipeline for what kind of growth can we expect coming forward, billings is currently over $2 billion, and it has 3 straight quarters of growing nearly 90%. That is good news. Short-term RPO, in other words, revenue that they're almost certain is going to be recognized within the next year. You like to see this growing fast, hopefully faster than revenue, and lo and behold, that is what we see, because revenue is growing 93%, but current or short-term RPO growing 105%. So this growth, it does have some legs to it. We can also look at long-term RPO to just see what type of long-term growth do we have, multi-year deals that might be signed. While that growth was nowhere near what it has been the last 2 quarters, it does usually go up in stepwise function. Wouldn't be surprised to see that happen again during the 4th quarter of this year. That is 3rd or 4th quarter, usually when those big step-ups happen. But you can't be too disappointed with 101% growth. And then finally, I like to really call this out, is the net dollar retention rate. Now let's think about what this means for a minute. If you have a net dollar retention rate of 100%, that really speaks to the moat of switching costs. Because if you have 100%, we're not paying attention to any new customers. This is just existing customers from a year ago. How much do they spend? If you have 100%, you've held on to all of your customers on average. But as you can see, Palantir has not only kept it over 100%, but it has accelerated that over the last couple of years, coming in at 157%. What does that mean? If you get rid of all the new customers that Palantir has gained over the last year and just look at, hey, in the 2nd quarter of 2025, how much money did that cohort of customers spend? The answer is not only did they spend as much as they did, on average holding on to all their customers, but on average, they got them to spend 57% more. That is top of the line. You will be hard pressed to find companies that are doing better than that. Let's turn to guidance for the next quarter. The Wall Street was expecting 69% growth, really heady growth for the current quarter, but Palantir said, nah, it's going to grow about 83%. Analysts give estimates for earnings per share. They expect that to more than double. The company gives adjusted operating income. Again, not my favorite metric, but they expect that to more than double, get close to tripling. Now, what should shareholders watch moving forward? A couple things I'm going to call out here. First is that current RPO growth. We want to see that growing faster than revenue for as long as possible. Now, they won't be able to keep that up forever because the revenue growth rates themselves are almost in triple digits. Second, net dollar retention. If you can keep that above 140 for a couple of quarters, that would be great. I don't expect that it's going to be able to accelerate forever, but man, did that look good. Third, our gross margins. When you have top of the line gross margins of almost 85%. Again, it's okay if it comes stable at around there, but I just don't want to see it falling below 80%. And finally, subscriber growth. I want to see how the company is doing there. There is absolutely, positively no doubt that the moat is widening around this company, and the thesis is very much on track. Of course, the big thing is valuation, because pretty much anywhere you turn, people will say, if they look at just the multiples, that Palantir is way, way, way too expensive, PE of over 100. But the fact of the matter is that's not the right way to look at it. And in fact, members of my program, Stock Investing Mentor, heard from me this morning, because it's the top of the month, where I give the top 5 stocks to buy for the month, that Palantir was one of those 5. And I talked about why during that. Now, how does that valuation picture change? We'll get to that in a minute. But if you're interested in joining Stock Investing Mentor, it comes in three pillars. The first pillar is that you get live real-time access to my portfolio with explanations for any moves that I make. Second, you get access to the antifragile stock universe, which includes antifragile scores, valuation rankings, and the 3 KPIs that are the most important to watch when a company reports, and what would a green, yellow, or red be for those metrics. And finally, 1 hour of live training every Thursday that's recorded, and 24/7 access to a private online investing community. If that interests you, Top link in the show notes below will get you 10% off an annual membership to Stock Investing Mentor. And it's not just that. By joining Stock Investing Mentor, you also get Stock Simplifier Pro absolutely free. That's a $400 value, absolutely free. Now, what does Stock Simplifier Pro do? Well, it does a lot of things. I pulled it up right here. One of my favorite things on this valuation tab is we do a reverse discounted cash flow analysis. Now, Palantir almost breaks this, right? Because if we were to just look at the multiples and say that it's trading for 108 times trailing revenue, man, that looks, or trailing earnings, that looks really expensive. But let's do a reverse DCF. Now, unfortunately, this reverse DCF tool only allows for optimized free cash flow margins of up to 50% because there's only, I don't know, one hand, maybe two number of companies that have free cash flow margins that are consistently above 50%. But as you can see here, Palantir is one of the companies. They currently have a 55% free cash flow margin. Let's assume that Palantir is, let's build in a margin of safety and say, hey, an optimized free cash flow margin of 50%. Because, man, it was over 60% for just this quarter. What would the valuation look like then? And the answer is well, if you give Palantir a 50% optimized free cash flow margin and a 3% terminal growth rate, then today's price assumes that revenue will grow about 30% per year for the next 10 years. Now, 30% per year for the next 10 years is a very, very, very high bar. However, Palantir is not your normal company. Analysts currently expect revenue to grow 73% during this fiscal year. We already know it's going to be higher than that because the new guide from the company calls for close to 80% growth. I think they're going to beat that. I think it's going to come in at about 85% revenue growth, which means that these estimates are probably too low as well. If you give them 85% growth for the current year, followed by 55 and 50% growth for the years that follow, I mean, then we're talking about over the next 3 years, 2.5 years, a growth rate that could be about 65%. Now, let me show you what happens if we factor that in. If we say over the next 3 years, the company is able to grow its revenue at about 65%, and it has 50% free cash flow margins, well, then revenue needs to grow about 15% per year from year 4 through year 10. For most companies, that is a very high bar, but for Palantir, I actually think this might not be that crazy. I know, it sounds insane, but even if you pull these free cash flow margins down to 45%, 17% growth per year for years 4 through 10, that's not that crazy. So Palantir, as expensive as you might think it is, has such incredible business momentum right now that I think it might still be on that list of pretty fair price for a phenomenal company. But that's just my opinion. Let me know what you think in the comment section below. And don't forget to hit subscribe for the next time Palantir reports earnings in 3 months. Till then, Brian.